If you're a NASCAR fan, you may already know the name of Kyle Busch.
And if you're not a NASCAR fan, you need to become aware of who Kyle Busch is, because him and his wife Samantha have just filed a massive lawsuit against an insurance company.
Kyle Busch first came across my radar when we lived in Nevada. My brothers put up an airplane hangar for a guy who lived near us. He was a Kyle Busch fan. He left the job site the day of the NASCAR race to go watch Kyle Busch race. Kyle Busch is one of the top 75 drivers in NASCAR history.
Kyle knew he wouldn't always be able to race. There would come a day when he wouldn't want to race anymore. And he and his wife planned for their retirement, but that planning hasn't gone so well.
And this brings up a question that we get a lot is, what about retirement with infinite banking? Now, they're using an IUL policy here, and that's why they're getting a lawsuit against it.
IUL stands for Indexed Universal Life.
The guarantees don't last very long in an IUL policy. 10, maybe 15 years at the most that I've seen in any contract. And so it's a speculation again, just like if you invested in the market or if you just bought a stock. You don't know exactly what that's going to do unless you know, a Warren Buffett that really has studied things. And even then, you know, Warren Buffett has made some bad investments too over his lifetime.
Now, it seems like from the very get-go, this case was kind of going south based on the way the agent was approaching the Bushes about setting up a tax-free retirement account, which happened to be IUL insurance, but tax-free retirement account is not a good name for IUL insurance. It's a marketing name, and it's probably a marketing name that should not be used. Definitely not with indexed universal life insurance. So we've got this 50-page lawsuit. We can see the allegations, and of course, this is still in court. So these are the allegations in the lawsuit that haven't been proven guilty yet. But as we're reading through this, there are a lot of things that we often see happening with the sale of indexed universal life insurance. So some of this doesn't surprise us all that much.
They can't sue this insurance company over the policy itself because the policy has certain guaranteed values. They don't last very long, but that's the policy and that's the contract. That's what he bought. But they are suing because of the communication in emails. They are going to present that in court and try to show that they were misled into purchasing this. The policy itself is a contract, and it is just what it is. And if people don't understand them, then they buy these policies. I don't know any other reason why they would buy these policies. Why would you put in? How much did you put in this policy?
Over really close to $10.5 million. I think it was $10.4 million that he paid in premiums to these policies over a number of years. And of course, he doesn't have that money now because the IUL investment portion of the policy, or the index part of it, didn't perform like he was promised it would by his agent, by the field representative of the company, by the regional vice president of the company, and even by the product design person that designed the product that the company's selling. And we often call those projected values the sales column. And even
love to use them.
Even in whole life insurance, there is the sales column, but it says right at the top of it, non-guaranteed values.
Well, it does in the IUL too, but people still like to look at it.
I don't know how many IUL policies that people have sent to us, and they never show us the guarantees because their agent never gave it to them. Sometimes they just sent them the projected values. Yeah. And we always go back and say, hey, this is not a complete illustration. It's illegal for this agent just to be showing you this if that's all they've done. Go get the full illustration so we can see what the guarantees are in this contract to see if it's any good.
And you could tell if it's a full illustration or not, because usually down in the corner, the right-hand corner or the left-hand corner, it will tell you the page numbers and that this is page 24 of 44. Or whatever it is. And oftentimes there will be missing pages. And oftentimes those are the pages showing the guaranteed values. So you can tell if you've got the full illustration by counting those page numbers.
So because they can't sue over the contract, they're suing over the fact that they were ill-advised. They were told things that weren't true.
They thought
misleading.
they were getting retirement planning advice, and it turned out it was simply an insurance sales pitch.
And of course, if the agent was not licensed to give retirement advice, now he's in trouble with the SEC because he's not a fiduciary. Life insurance agents, unless they have, a Series 65 or some other type of education, they are not fiduciaries. All they are doing is representing a product that the insurance company has provided. And so if they were talking about retirement planning and retirement, a guaranteed, now they've breached their contract.
As you're reading through this, it turns out that the agent has a criminal record too, and that didn't come out during the process like it should have. It wasn't disclosed, and so that they're complaining about that. One of the things too is they thought they were only going to have to fund these policies for a certain number of years. The agent even confirmed that in writing, and even someone I think from the home office confirmed this is like the final premium. You got to pay it soon. Otherwise, because taxes are changing with the Biden administration passing this bill. And so they paid these premiums and they thought this was the last premium. Then they get a bill for another premium. That happens very often with Index Universal Life Insurance because maybe it didn't show any more premiums on the non-guaranteed side, but what about that guaranteed side?
So let's stop right there because that is a huge sales tactic in almost all IUL contracts that I've seen or heard about. They say, oh, look, this index that this policy is mirroring is going to do so well that your premiums are going to stop right here. You're never going to have to pay another premium. And look how much this is going to grow for you. Now, that's different than a whole life policy where you can reduce the premium, get rid of part of the death benefit, and not ever pay a premium again. That's called a reduced paid up policy. Very possibly, very easily done with a whole life policy. It can't be done in an IUL policy with a guarantee because the cost of the insurance keeps rising over the rest of the life of the insurer. And if that index that they're mirroring isn't performing well enough, they're going to get hit with a premium notice. It's kind of like a margin call. And if you can't come up with the money, now you've got either a policy that lapses, and if it lapses, you could end up owing quite a bit of money in taxes as well. Because if it's been borrowing from the fund that's been growing this policy, the cash values, they've been borrowing from that to pay the premium because they said you don't have to pay it. Guess what? Now that's all considered income for you.
Our CPA referred a client who had bought an IUL policy, put about $500,000 into it over the years, and he had the policy for several years, had taken the policy loan early on, and had let the interest get added to the loan balance for several years.
The sad thing about this policy was going to lapse that year because they'd borrowed everything they could out to pay the premium. There wasn't $1 million in there to pay the premium this year. But because he had borrowed so much from this, he was going to have a tax liability of over $3 million of income happened to be declared that year if the policy lapsed.
Yeah, these just aren't good policies. And, even if someone doesn't borrow out of it, and they go ahead and continue paying their premiums, there will be a day when they can't afford the premiums anymore because Universal Life is built on a renewable term. That's the foundation of how the policy is built. So, your cost is low at the beginning, but each year it rises. And they tell you, oh, but the money's in the market, the investment, the indexing, whatever's going to happen, it's going to produce so well. But it doesn't ever we've never seen it produce enough to overcome this ever-increasing cost of term insurance. And a lot of people aren't even aware of this increasing cost until the day their policy is going to lapse without further premiums, because in the early years, they put extra money in because their insurance doesn't cost that much. So the premium they pay, not all of it is used towards purchasing that death benefit. Some of it is put into a cash account, and that accumulates over the years. Well, there comes a day when the amount they pay is no longer enough to support the policy. So they start taking out of that cash account the money that you thought might be there in retirement. They start putting that into adding it to your premium so it can go on. That can go on for several years. And then all of a sudden, oh, there's no money in the cash account. Okay, your premiums are now XYZ, much larger than you were ever paying before.
So most policies that I've looked at are based on, IUL policies are based on 1 year renewable term. Some of them I've seen, they keep a level term for 5 years and then it jumps. And then it jumps again at 10 years. So not all IUL policies are the same. But what happens is one policy I was looking at, his cost of insurance was going to go up over 4,000% if he kept that policy for 30 years. Well, if you're keeping it for retirement, you're going to keep it for 30 years. And if that index in that policy doesn't perform and generate enough to cover that $4,000 cost of insurance increase, then that's going to come back on you. And the problem is that most of these policies are sold is that they're sold with the idea that you can underfund them for the first few years. So there's a target premium that the insurance company knows that has to be paid to meet the guarantees in the policy. But one policy I was just looking at, they weren't even paying 50% of that target premium. And so what's going to happen is they're going to have issues much sooner because this is going to be borrowing from the growth fund.
This is the Infinite Banking Made Simple binder. Everything you need to know about infinite banking in one spot. And it's a free download. Answers to the top commonly asked questions like what is infinite banking, how does it work, and how much does it cost to get started are answered right here. You'll find the step-by-step diagram starting on page 7 and the investment comparison on page 8. This Infinite Banking Made Simple binder is a free download. You can click the button to get your copy. At McPhee Insurance, we believe infinite banking has become too complicated and confusing, but it shouldn't be. And that's why we created this binder. Infinite banking is simple when you stick to the essentials and the facts. And the people who put it into practice get results. Don't let insurance terms like modified endowment contracts, 7-pay tests, direct recognition, and paid-up additions keep you from understanding infinite banking. Download the free binder and see how infinite banking can work for you.
We don't want to be negative about life insurance, but there are some things in the life insurance field that have created a lot of negativity. IUL is one of those. And you can just Google it and find out how many lawsuits have been filed against insurance companies because of their IUL policies. And so there's basically 5 things that you need to be really careful if someone approaches you talking about selling you an IUL policy. The first one is that most of the illustrations that I've seen, I won't say all of them, but most of them are way over optimistic in what the returns that you're going to have.
It's
John,
true.
You've done some research on that.
Yes. In fact, there was just a regulation that came into effect in 2023 to limit how high the insurance carriers can allow their software to illustrate an IUL product. That's not keeping certain agents from pulling values and using their own illustration spreadsheets. It's kind of interesting how that's happening. We saw an example of that just the other day. But something that's interesting, when you look at an IUL policy, there will be something that's called the cap rate, usually. If it's tracking something like the S&P 500, which many of the IUL products do, they'll have a cap rate. So they'll say if the S&P 500 does really well this year, maybe over 10.5%, you'll be capped at 10.5%. But in exchange for that, when it does really bad and it loses money, you're not actually going to lose money due to the performance of that index. Now, how does that work out in real practice? Well, you're going to get probably somewhere in between the cap rate and 0% if the market keeps doing what it's doing. I looked at an example that was comparing multiple products with a 10.5% cap rate based on the S&P 500. And the way that they do it, they look at it in rolling periods. So they figured out a percentage. You know, what's the likelihood of earning 6.5% in this IUL product?
What's the probability?
What's the probability? Less than 20%.
Yeah. Okay. Over optimistic illustrations.
They'll often show 6 or 8%.
And along with that is that oftentimes the sales agent will say, you can't lose money because we cap it at 0, or the basement is 0. And if the index goes negative, you won't lose money. But that doesn't take out the fact that they're still going to charge you fees. They're still going to charge you, the increased cost of interest. So you can lose money.
Yes.
And that's why Kyle Busch and Samantha are filing this lawsuit.
The other thing that we often see with IUL illustrations is unclear fee structures. So you start a policy thinking there are going to be no fees, and then you're looking at the guaranteed values later on the illustration, and you see that they go to 0. Why did they go to 0 if there are no fees and you can't lose money from the index? Well, there are fees that are being taken out for the cost of insurance, and there are fees that the insurance company can change along the way.
Every life insurance policy has a fee. It's called a policy fee, whether it's term, indexed, whole life, universal, variable, there is a fee because the insurance company charges a fee to sell their product. And that can be anywhere from, $75 to, I've seen it as high as $300 a year. Okay. That's just a flat fee. It comes right out of the premium, right off the top. IUL policies also have a fee of a percentage of what you pay in premium. So it entices you to pay a lower premium so you won't lose so much in a fee. And that sets you up for failure down the road too, because if you pay $50,000 for a premium instead of $250,000, you don't pay as much because it's based on an interest rate of what you're paying. And then there's also a fee on some IUL policies on how much you accumulate in your cash account. So they might charge a fee at the end of the year on that, and before they give you your total. So very unclear fee structure.
And sometimes there's a fee to buy up your cap rate. So let's say that they would typically issue a policy with a 7% cap rate, but you would like it to be 9. Well, there would be a fee to get it up to 9.
So years ago, one of our clients had a whole life policy, but then they were also listening to information on the internet and decided to buy an IUL policy. And they were paying $5,000 a month for this IUL policy. And I remember they contacted us and met with you, Tom, and they were having some concerns. It was the very first year of their policy. And you said, well, why don't you send it over to me? And you printed it out. It was a huge, thick document. And you went through with a highlighter and you started highlighting all the fees and all the things that could change. And a huge percent of that document was highlighted when you were done. And I remember I think that was one of the first whole IUL contracts that you had seen and read. And you were just shocked. You ended up helping that client get the money back that she had paid for it because she was sold it under a completely different idea of what it was going to do and how it was going to perform.
Misrepresentation and an over-optimistic view of fees.
Yeah.
It's inherent in these policies. And that's why we really encourage people just to avoid them, because all that thick book of contract on that IUL policy was written by attorneys for the insurance company, not for the policyholder. Mm-hmm. And if you don't understand all the legalese and you're getting into something, there's smarter people than myself that have bought these policies.
Yeah,
that's the beautiful thing about whole life contracts. They tend to be relatively simple, very simple compared to the IUL. The length of the IUL contracts, whole life focuses on the basics. It's easier to know what you're getting. Something else we often see related to IUL sales practices is people that are getting pressured to roll over like IRAs, take money out of IRAs to fund IUL, thinking that it's going to be a tax-free retirement instead of an IRA where you'd be paying taxes as you pull the money out. It sounds nice, but you're going to have a 10% penalty. You're going to have to pay the taxes today. The IUL is going to have to do really well to make up the difference, even when we're talking about whole life. Occasionally people decide, I have some qualified money that I'm willing to pay the tax and penalty on so I can use the money. But it's the use of the money that's going to recover the penalty and the fees, the taxes that they're going to pay. So it has to be a very specific, informed decision if they're going to do that. If they're doing it to fund IUL and thinking the IUL is going to make up for it, that so often doesn't happen.
So this brings up something. When I was first getting my license, and I had read Nelson Nash's book and understood that we wanted to participate in whole life, then I was looking and trying to read everything I could about it, and I picked up a book called Misfortunes 101 by Doug Andrews. And Doug, in his book, was recommending people to take out massive HELOCs against their home to buy IUL policies. And I got all excited because the numbers look fantastic in there, And then I went to take my insurance exam. And the trick here is that IUL policies are called permanent life insurance. And so is whole life insurance. It's classified as permanent because it can last your whole life if you pay the premiums. But a lot of term policies can last your whole life too if you pay the premiums, but nobody's going to do it.
Nobody's going to do it, yeah.
And the IUL hides the increasing cost of the term insurance in its
So whole life is
legalese.
So whole life is classified as permanent. It is truly permanent because you have a premium that's guaranteed never to go up. IUL is classified as permanent, but the premium can go up.
And the difference is that whole life insurance is the only insurance that you actually buy and own the life insurance. It's like buying a car. You make payments on it. You end up owning that car. You buy a house. You make payments on it. You finish the mortgage. You own the house. So whole life is the only one that you do that. All the other types of insurance are sold out. You are renting life insurance. That is going to go up over your lifetime because the closer you get to the time you're going to expire, the higher the premium is going to become.
So you were looking at this HELOC strategy. Were you borrowing from a HELOC, funding an IUL?
So it was confusing to me as a new agent going to take my test. I went in to take my test. And even on the test that I took, they were classifying permanent life insurance and not differentiating whether it was IUL or whole life, and then wanting me to answer A, B, C, and D questions that I knew didn't apply to whole life, but definitely applied to IUL. So how do you answer that question and get it right?
There's a lot of confusion about Index Universal Life, and a lot of agents get started and are really pushed into selling Index Universal Life. We've asked insurance companies why they sell it. It makes them a lot of money. It is a product that really puts the risk back onto the insured. And insurance is supposed to take the risk away from the insured. So it's really built on shifty ground. If you're building a house, do you want a solid foundation? Do you want to build it on sand? You might be able to get the house up quicker on the sand, but it's going to shift and it's not going to be there for you.
So the fourth thing that often is seen in these policies is they talk about the variable or flexible premium. And they say, well, if you start out real aggressively and pay more into this policy, you won't have to pay premiums later. Mm-hmm. Or you could start out real aggressively and, next year if you can't make it, the premium's flexible, you don't have to pay that much. Those type of things can get you in trouble in an IUL policy much quicker because it's based on the fact that cost of insurance is still going to go up. And if you don't pay the premium you started with, that's the numbers that are projected. And you're thinking this is going to be here to cover your bases if you don't come up with it. And it doesn't always work out that way.
IUL is the new kid on the block, and it is often touted because it's flexible premiums. That is a hallmark of a feature of universal life insurance products. And there are different types of universal life insurance. Some are tied to an interest rate. That would be plain universal life. They've already got a bad name because interest rates didn't stay high like they were in the 80s and the 90s. You have the index universal life insurance that's tied to an index. Now it's getting a bad name. And you have variable universal life insurance, which is tied to the stock market. So maybe it does well, maybe it doesn't, but it's tied to the stock market. And those products often peter out as well because all universal life insurance is built on the increasing cost of insurance. You're taking the risk for that. And so how flexible are the premiums? Only as flexible as the cost of insurance.
And that flexibility and variability also applies to the insurance company. They can raise the premium. They can change it.
And they have a lot more flexibility than they do with a whole life insurance contract where those details are set in the contract.
Yeah.
And the fifth thing to be concerned about is sparse or inconsistent information. If your agent is telling you something, but you're not able to read it in a document, you want to be very careful. The whole lawsuit that's going through with Kyle Busch, it's not based on the contract itself, but it's based on the information he was told, and it's been documented in an email. And so that is going to be the evidence that they produce at the trial.
We talked about this earlier when we talked about the illustrations we get from people that have been sold an IUL. they're not complete illustrations. And if we look at some other lawsuits that have gone out, they don't even use the insurance company's illustrations. They pull data from those illustrations and put it in their own spreadsheets and their own documentation.
I was looking at one just the other day. Here's an example. It's on a spreadsheet. It looks like a life insurance policy. And sometimes it's reasonable to do this, like copy the values from an illustration, put them into an Excel so you can run some calculations on them. That's reasonable. But when you look at this looks nothing like the illustration that was behind this product.
So if they're selling off their own software illustration rather than the insurance company, that raises a red flag. Doesn't necessarily mean it's wrong, but you want to verify that those numbers are consistent across the board.
Totally.
When we meet with clients, we always want them to understand what's behind these numbers. We want to look at the actual numbers, look at the actual illustration to verify what we're saying. And we want to explain enough to you so that you can go, oh, yes, that makes sense. I can see from this that is true. We want you to have that information.
We want people to be educated. We want people to make a choice based on their knowledge that they have gleaned, not just because we're trying to sell a life insurance policy. We didn't get into the life insurance sales because we wanted to make a lot of money. We got into this because we had bought life insurance and were able to keep more of the money we were making. And that's what we want to share with other people. And that's why we do infinite banking. That's why we sell participating whole life insurance, is because of what it's done for us. We want other people to benefit from that as well.
It seems like whenever we talk about IUL insurance, there will be IUL salespeople, agents who tell us we're just not looking at a well-designed IUL policy. So here we are. We are asking you, inviting you, begging you to send us a well-designed IUL illustration. You can send it to producer@wealthtalks.com. We want to see that illustration. We will review it live here on the podcast, and we will be happy to give you a shout out.
If there's one takeaway from today's show, stay away from IUL. The pitfalls are countless. Buy whole life insurance, participating whole life insurance that has a contract with guarantees you can count on.
That's a wrap for this week. See you right here next week on Wealth Talks.